Welcome to my training video on Compensating Executives by Dasheil Smith. Defining executive status. Who are executives? Executives are key and highly compensated employees with holding positions of substantial responsibilities in a typical organizational structure. These type of titles include CEOs, presidents, executive vice presidents of functional areas, as well as directors of accounting, directors of finance, directors of human resource, directors of marketing. Key employees are any employees who at any time during the year is an officer having annual pay of more than $170,000 or an individual who was either of the following: a 5% owner of employer's benefit business or a 1% owner of employer's business whose annual pay was more than $150,000. Difference between non-executive pay and executive pay. Chief Executive Officer, also known as the CEO, is the seller of his or her services. The CEO hires a professional compensation director or a compensation consultant to perform an objective analysis of the company's executive pay package. The compensation consultant makes the recommendations to the compensation committee, who works for the CEA, and makes whatever recommendations the consultant feels are appropriate. Non-executive pay employees are normally paid for performance, which applies to most. Executive pay employees, they are normally rewarded even after they have not performed well. They tend to reap multi-million-dollar awards contingent on their leaving the company as well. This is something that is increasing more and more in the world of executive compensation. Components of executive compensation packages. The main components of executive compensation includes the following. Beginning with current or annual core compensation. This is normally paid on an annual basis. It's an annual base pay as well as bonuses. Deferred core compensation equity agreements refers to company stock and stock options. It's an agreement between an employee and a company to render pay to an executive at a future date. Deferred core compensation separation agreements. Most executives' employment agreements contain a golden parachute clause, which provides pay and benefits to executives after a termination that results from a change in ownership or corporate takeover. This is with the merger or combining of two separate companies. Clawback provisions. In CEO employment contracts, it allows the board of directors to take back performance-based compensation if they were to later learn that performance goals were not actually achieved, regardless of whether the CEO was responsible for performance failing short of the target levels. Employee benefits, enhanced protection program benefits, and prerequisites. This consists of supplement life insurance and supplement executive retirement plans. For executive employees, it's a protection program for other employees. The employer provides life insurance protection on employees' families by paying a specified amount to an employee's beneficiary upon an employee's death. It also is a qualified plan entitled to employees to favorable tax treatments of benefits they receive upon their retirement. Income generated in the pension program is not taxed until employees retire. Principles and processes in setting compensation packages. The key players in setting executive compensation includes compensation consultants, compensation committees, and board of directors. Each plays a different role in setting executive compensation. Executive compensation consultants usually propose several recommendations for alternative pay packages. Consultants make recommendations about what and how much to include in executive compensation packages based on strategic analysis, which entails an examination of a company's external market context and internal factors. Compensation committees. They are normally outside director committees memberships to minimize conflict of interest. Compensation committees perform three duties. They review consultants' alternative recommendations for compensation packages. They discuss the assets and liabilities of recommendation, as well as recommend the consultant's best proposals to board of directors for its consideration. The board of directors, they represent the shareholders' interests by weighing the pros and cons of top executive decisions. Board of directors give final approval of compensation committee's recommendations as well. Summarizing compensation package rules and reasons for establishment. Two laws in particular are responsible for these requirements: Securities and Exchange Act of 1934 and the Wall Street Reform and Consumer Protection Act of 2010. One of the main goals is to help prospective investors understand the financial matters of importance to themselves. The SEC is a nonpartisan federal government agency with responsibility for the administering federal security laws. Let's go into further detail on Securities and Exchange Act of 1934. The Securities Exchange Act of 1934 applies to the disclosure of important company financial information as well as information about executive compensation practices. The Wall Street Reform and Consumer Protection Act of 2010 further enhances the transparency of executive compensation practices, requires the companies that trade stock on public exchange to comply with four major provisions. These provisions are as follows. The first provision requires say on pay. Say on pay gives company shareholders the right to vote yes or no on executive compensation proposals that are contained in proxy statements, including current and deferred components and golden parachute agreements. The second provision details independence requirements for compensation committee members and their advisors, such as compensation consultants and legal counsel. Members of compensation committees typically receive a compensation for their services, and this practice is considered to be acceptable. Third provision requires that companies disclose the circumstances under which an executive would benefit from a golden parachute agreement. Specifically, disclosure is required of all agreements and understanding that the inquiring and target companies have the executive officers of both companies. The fourth provision requires that companies report the ratio of CEO compensation to the median compensation of its employees in SEC filing. That require executive compensation disclosure. This disclosure will help inform shareholders when taking a say-on-pay vote. The rule provides companies with flexibility in calculating this pay ratio. Thanks for watching my training video on compensating executives' pay. I hope that this was beneficial, that you gained a better understanding and knowledge of the topic in which was discussed. Thanks again, and have a wonderful day.